We have curated the most popular tax strategies on the internet to reduce gains on the sale of crypto assets. In this episode of Taking Shelter, I'm joined by Matt Crypto Costa to give our take on all of these strategies. Welcome, I'm your host, Peter Paulson. I am joined again by Matt Costa of Bestgate Wealth Management. Matt is a tax pro with crypto clients. He is a crypto investor himself, and he is a wealth advisor. Welcome to the show, Matt.
Good to be back, Peter.
So today we're going to focus on taxation of token appreciation. If you want to see Matt and I comment on all kinds of crypto transactions, then go back and watch our other video on this channel. A few things, three quick comments. Number one, crypto has been going up and down lately. The price of Bitcoin today, as we record, is around $55,000. Also, we don't have details of the Joe Biden tax plan at this point in time. There will be a lot of negotiations. So today we're just going to deal with rumors and go forward on that basis. And then finally, we have split this video into two parts. We go over the agenda. The part one will include basic strategies, and will also include discussion of financial products, and that is financial products that I like for crypto investors. And then in part two, we'll pick it up with financial products I don't like for crypto investors, and then some lifestyle changes, including not reporting your crypto or moving to Puerto Rico. So Matt, let's dig in. The first category, agenda category, are basic strategies. And I start out with a couple of starter gifts that the IRS has given everybody. So back in 2014, the IRS said that the crypto is property, and if you sell property, you can get a capital gain long-term rate if you hold it more than a year of 15 or 20%. And then that annoying Medicare surcharge, if it applies. Matt, that's better than Powerball winnings. That is better than working for a living. What do you think of those benefits, and what do you think Joe Biden might do to those benefits?
No, certainly, and long-term capital gains rate is what you want to play for. If you're in those bottom two tax brackets, it's a 0% rate. So a married couple as of today making around $100,000 a year has a long-term capital gains rate of everything below that of 0. Then you have 15%, 20%, and as you said, the surcharge as well. But things can be changing. There are proposals for this 43% rate. On short-term rates, it's taxed as ordinary income, but still relatively low if you're in a lower income tax bracket. But it certainly, like you said, it is better than a Powerball winning.
And the other benefit the IRS has given you is the ability to be somewhat selective if you sell less than all of a certain type of token. So if you have 6 Bitcoin, you sell 1, you have the ability to identify which one you sold and try to pick your highest basis out if you want to do that. But in the context of the Biden tax reform, if the capital gain rate goes up and you sell Bitcoin today, you might want to pick your lowest basis and try to lock in your gains at that 15 or 20% rate that exists today. Matt, do you think that it's possible that everybody's going to run to tumble their coins at the end of the year and try to accelerate gains into what could be the last chance at a low rate?
Certainly could happen. I remember back to 2017 when transaction rates were so high with the retail market exploding and a lot of people trying to get their transaction on the blockchain. So it certainly brings back some flashbacks from then. I can certainly see that happening. There are secondary layer solutions coming online, whether it's the Lightning Network and other ways to get more throughput in the blockchain, but it certainly could have some adverse impacts there on transaction fees and everything that makes the blockchain work.
Yeah, we'll have to stay tuned. We'll continue to monitor the timing of this rate change, the severity of this rate change, but it could result in a lot of activity right around the end of the year, which could be a pretty good test for the blockchain. Let's talk about the most popular strategy on the internet, which is holding, having your diamond hands and never selling. To me, Matt, that is an investment strategy with a tax outcome. I remember when I was in the dot-com bubble. I bought some Oracle. I got 3 or 4x on it. Really happy, wanted to sell it, buy something with it, but I also wanted to hold for that over 1 year lower capital gain rate tax, and it did not end well for me, Matt. So how do you view this hold? Do you view it with your tax hat on, tax advisor hat on, or your investment advisor hat on?
I view it favorably from both lenses. You know, with the tax strategies, it doesn't have a whole bunch of adverse tax impacts where you have to do a bunch of transactions on your Schedule D, your 8949. I always like to think how Warren Buffett thinks, in the sense of buy something and hold it forever, hold it a really long time if you have that conviction. You know, Bitcoin has been growing. If you look at it over the last 11 years at around 200% per year, just hold it. You know, why trade it and add more risk into it? If you can just hold it, something that's appreciating, you will have done pretty well.
Yeah, I think there are some, if you're into a long-term hold, there are some variations on this that get a little bit more interesting. There's a hold and borrow strategy. So if you're like Michael Saylor, you're going to hang on to this for 30 years, but you want to enjoy some of the appreciation, you want to buy a car, what have you, then you can go on a platform and you can use your tokens as collateral to get a loan. And I recently watched a couple of really good videos by Mariah Monetize on borrowing on the Nexio.io and Celsius platforms. Matt, I believe you use BlockFi.
Yeah, BlockFi is one of the big players out there, and you can borrow against your crypto at, say, 50% loan to value, maybe 30%. You have to understand at a 50% loan to value that you have a higher interest rate. I think it's around 8 to 9% now versus if you're only borrowing up to 30% loan to value. But it certainly allows you to access some liquidity without having that taxable event of selling your Bitcoin, your other cryptocurrency. There's other benefits there as well. I'm just thinking about holding in general. If you're not borrowing against your Bitcoin, you actually have a positive carry. There's a good interest rate, maybe 3% to 5% to hold your digital currency on this site. So it certainly incentivizes you to hold or borrow against it just to not deal with that tax impact.
Yeah, and kind of a cautionary investment observation is that you do have this loan to value ratio, and so if the value of your currency goes down, you may be forced to sell at some point when everybody else is trying to sell, your exchange is crashing, and you could feel like you're on the wrong end of a GameStop short squeeze if that's the case. So just a little word of caution there. The add-on to that is, and we get this off the internet, we don't sit around and make this stuff up, but it's the hold, borrow, and die strategy, where you take advantage of an existing rule that allows you to step up the basis of your assets when you die. And so your survivors get those assets with a fair market value basis, and you never pay tax under today's laws on the appreciation of the assets. That's the buy, borrow, and die strategy. What do you think of that long-term strategy, man?
I love that strategy too. The thing you just have to make sure is you plan for that. You have to tell someone. So biggest issues with cryptocurrency is you don't have it at typically a Fidelity or Schwab where they're the custodian and they understand the beneficiaries and can execute on your wishes upon passing. So the solutions now are, you got to tell someone. You have to account for it in your will. You have to build trust. There's good multi-signature solutions. There's a company out there called Casa I've talked to recently, and they do a great job with multi-signature wallets. So maybe you need something like 3 of 6 signatures. And in that sense, you would maybe the holder of the cryptocurrency has 3 signatures to sign a transaction to move the Bitcoin. And then if they were to die, Casa's got a signature. Maybe their lawyer's got a signature. Maybe the beneficiary does. They can gather 3 of these signatures to move the Bitcoin from one wallet to the beneficiary without fearing losing it. So you have to do more planning, but it certainly is a good strategy to make sure wishes are done with transference of property.
Yeah, I think someday, Matt, there's going to be a sad story circulating in the news about a crypto investor who somehow gets incapacitated and they don't have a financial power of attorney allowing somebody else to step in and trade out their currency, and they have the private keys buried in the mason jar in the backyard, and they need all this long-term care, and they've got all this cryptocurrency that is basically gone at that point in time. and that is going to be a sad story. It's something that you want to think about avoiding if you're making good money in that crypto space. So let's talk about happier things. Financial products I like for typical crypto investors. So Matt, let's say you want to invest $6,000 in Cardano or Doge, and you want the IRS to kick in $2,000 of that investment. That's called a regular IRA, self-directed IRA. And what you can do is you can put cash into the IRA, and then you can deduct that on your tax return, and at whatever rate you're at, federal, state, you get money back essentially. So the IRS in your state maybe kicks into your IRA investment. They actually become then your partners, and so if later you take a distribution from the IRA, they're going to want to be there with you and tax it at ordinary income rates. You don't get capital gain rates at that time. But a interesting strategy, Matt. What do you think of that?
Another strategy I love, I use Kingdom Trust. Kingdom Trust is a newer provider out there, but they can allow you to hold cryptocurrency individually in your IRA. Custody of Fidelity Digital, they settle their transactions with Kraken. There's certainly fees involved with that, but it's a great way that it simplifies tax with tax compliance, because you're in that bubble there in an IRA. That bubble allows you to trade from Bitcoin to Tether, back to certain other assets, any asset really, and not have a taxable event until withdrawing it if you're in the traditional, or never if you're in the Roth. And I really love the Roth IRA because if you get it in there in this high growth space, it gets to grow tax-free forever. So I certainly advocate for Roth retirement accounts. Another thing, if you're a business owner, a 401k, a solo 401k or SEP, and certain things like that, you can invest in these assets as well in higher dollar amounts than just a traditional or regular Roth IRA.
So if you have a regular IRA, the IRS is your partner. They're going to be with you the whole ride. If you have a Roth IRA and you put that $6,000 in Dogecoin and it goes to the moon, that is tax-free income. Now, it's not all wine and roses. There is a 10% early withdrawal penalty if you take it out before you're age 59 and a half and you don't meet some exception. There can be significant fees. There's this little trap out there called UBTI, where some business type income can be hit with a 37% tax rate currently. And the question is whether something like mining, staking, or lending is business income, or is it the type of investment income that is typically perfect for an IRA. So the other financial strategy I like for the typical crypto investor is donated. And donations are not typically a tax strategy. You either are a donative or not donative. Giving Block reported in December of 2020, over $2 million of crypto was donated, and deductions are, of course, available for donations. What do you think about that, Matt?
No, it's a great strategy in the sense that you want to donate appreciated property. It's much better than donating cash. So if you sold Bitcoin or any cryptocurrency to cash and then donated it, you'd have that taxable gain, and then you take a deduction wiping that out, mostly. But if you gave appreciated property, you get a deduction for that value without having to incur that gain on your tax return. So it makes a lot of sense. And then, like I said, there's great services out there like the Giving Blocks that can facilitate those deductions for you and simplify the whole process.
And you can use something called a donor advised fund too, which allows you to essentially accelerate or prepay a lot of donations that you would make in the future, and you don't even have to identify the charity right away. But you can take a full deduction up front and then have a period of time over which to make those donations. So that's pretty attractive as well. But we're going to conclude part one with that. Please tune in to part two, where I will talk about financial products that I don't like for typical crypto investors, and then lifestyle strategies, including not reporting your crypto and moving to Puerto Rico. Thanks for watching. This has been Taking Shelter. I'm your host, Peter Paulson.